If you have money sitting in a savings account right now, your bank is quietly making money off it, and you're getting almost nothing back. I know because I did exactly that for years. I had $8,000 just sitting there. Safe. Comfortable, going nowhere. Then I made a decision that, looking back, changed my financial life completely. I started investing with no experience, no finance degree, no rich family to guide me. And over the next 7 years, that $8,000 turned into $94,300. I'm going to show you exactly how, every year, every number, including the years I lost money, the mistake that locked up $12,000 for 14 months, and the one thing I wish I had done 5 years earlier, because it would have made me an extra $40,000. No fluff, no selling you anything, just the real numbers. 7 years ago, I had $8,000 sitting in a bank account earning basically nothing. A friend told me, just invest it. I had no idea what I was doing. I was scared. I thought investing was for rich people or for people who understood spreadsheets better than I did. So I did what most people do. I waited and waited and waited. Then one day I just did it. Today, that $8,000 plus everything I added along the way is worth $94,300. In this video, I'm going to show you exactly where that money went, what worked, what completely failed, and the one mistake that cost me nearly $11,000 that I wish someone had warned me about. Let's get into it. So, 2017, I was 27, working a normal job, making a decent salary, nothing crazy, but every month, money just disappeared. Rent, food, going out. I wasn't broke, but I wasn't building anything either. I remember sitting down one evening, opening my banking app, and realizing I had been working for 4 years and had almost nothing to show for it. That was uncomfortable to face. A colleague of mine, older guy, mid-40s, casually mentioned one day that he didn't need to worry about his pension because his investments were already taking care of it. I asked him how. He said he'd been putting $300 a month into index funds since he was 30. That conversation changed everything for me. I went home, spent 3 weeks reading everything I could find. Most of it confused me, but eventually one idea became very clear. You don't need to be smart, you just need to start. And you need to be patient. So in January 2018, I opened my first brokerage account. I put in $8,000, almost everything I had saved, and I made my first investment. Okay, here are the real numbers. No rounding up, no hiding the bad years. I put in $8,000, mostly into individual stocks at some European companies, a couple of US tech names. I thought I was clever. By the end of 2018, my portfolio was worth $6,400. I had lost $1,600 in my first year. I was devastated. Looking back, 2018 was a rough year for markets generally, but I also panicked and sold 2 positions at exactly the wrong moment. Classic beginner mistake. I'll come back to this. This is where things started to shift. I stopped trying to pick individual stocks and moved most of my money into broad index funds, mostly a simple MSCI World ETF. I also started investing monthly, $400 per month, automatically every first of the month. I stopped watching the prices daily. That alone reduced my stress enormously. End of 2019, portfolio value, $11,200, a recovery. And more importantly, my mindset had changed. 2020, you know what happened. In March, my portfolio dropped to $7,800 in about 3 weeks, and I did something I'm genuinely proud of. I didn't sell. I actually increased my monthly contribution to $500. By December 2020, the portfolio had recovered to $15,600. That year taught me more about investing than any book ever could. 2021 was the feel-good year. Markets were up. Everything looked easy. I added a new element. I put $12,000 into a real estate crowdfunding platform. European property seemed solid. End of 2021, total across everything, $34,200. I also started a small position in bonds, low excitement but important for balance. When then 2022 arrived, inflation, rate hikes, tech stocks collapsed. The real estate platform I had invested in froze withdrawals for months. By the end of 2022, I was sitting at $7,800, down about $6,000 from the previous year. That real estate investment, still locked, still waiting. This was the year I truly understood what risk actually means. Not as a word in a brochure, but as a real feeling. 2023 was the year of patience paying off. Markets recovered. My ETF positions grew strongly. The real estate platform finally released most of my funds, with a modest return, but the anxiety it caused was not worth it. I shifted strategy, simpler, broader, more boring.
End of 2023, $61,400. That jump? It feels good to say that number out loud. This year, I've continued the same approach. Monthly contributions, broad index funds, a small bond allocation, and one satellite position in a dividend ETF. Current portfolio value as of now, $94,300. From $8,000 to $94,300 in 7 years. That includes roughly $42,000 in total contributions over the years. So the market actually grew my money by around $52,000 beyond what I put in. Compound interest is not exciting to talk about. But $52,000 in growth, that's real. Okay. The part people actually come for. Here are the 3 mistakes that cost me the most. In money and in sleep. I sold 2 positions in late 2018 when they dropped about 18%. I locked in a loss of around $900. Both of those companies recovered within 8 months and went on to roughly double in value over the following years. If I had just done nothing, literally nothing, I would have been significantly better off.
Lesson: your instinct to do something when markets fall is almost always wrong. I put $12,000 into a real estate crowdfunding platform in 2021 because the returns looked attractive, around 7–8% annually. What I didn't properly research was the liquidity risk. When the market shifted in 2022, I couldn't access my money for nearly 14 months. The investment didn't lose money in the end. But that 14 months of not being able to touch it, during a period when I could have used that capital elsewhere, had a real cost. Lesson: if you can't afford to lock up the money, don't invest it somewhere illiquid. This is the one that genuinely keeps me up at night when I think about it. If I had started at 22 instead of 27, just 5 years earlier, and invested the same amounts, my portfolio today would be estimated at around $130,000 to $140,000 instead of $94,000. 5 years of compound growth. That's the difference between 94K and 135K. The best time to start was yesterday. The second best time is today. I know that sounds like a motivational poster, but the maths genuinely back it up. If I were starting from scratch today, with everything I know now, here's exactly what I would do. 1. Open a low-cost brokerage account. In Europe, options like Trading 212, DeGiro, or Interactive Brokers are solid starting points. 2. Put 80% of my investment money into a single, broad, global ETF. MSCI World or FTSE All World, set it up as a monthly automatic investment and then forget about it. 3. Keep 10% in bonds or a money market fund. Not exciting, but it smooths out the rough years. 4. Keep the remaining 10% for anything speculative, individual stocks, thematic ETFs, whatever interests you. But treat it as money you're okay losing. 5. Never check your portfolio more than once a month. Seriously, the more you look, the more tempted you are to react. Reacting is expensive. 7 years, $8,000 in, $94,300 out, and growing. Was it always comfortable? No. 2020 and 2022 were genuinely stressful, but the strategy worked because I kept it simple. I kept contributing, and I didn't let fear make my decisions. If you're sitting on money right now wondering whether to start, I'm not going to tell you what to do. I'm not a financial advisor, and your situation is different from mine, but I will tell you this. Waiting has a cost too. It's just a cost you don't see on a screen. If this was useful, subscribe. Next week, I'm breaking down the exact ETFs in my portfolio right now with the actual allocation percentages. See you then.